Good morning, students. My name is Yurajsinh Rathod, Assistant Professor, Department of Commerce and Management, Rai School of Management Study. Today we are going to learn about capital structure theory. It's a topic of financial management. I am start with the introduction part. What is capital structure? Capital structure is a combination of debt and equity finance. Organization raise their fund by using different source of finances like mentioned in the PPT. So they are using bond, long-term note payables, debentures, equity shares, preference shares. So organization are using different kinds of source, long-term and short-term. In short-term, debt such as working capital requirement is also considered to be a source of finance for the business organization to run their operations accurately. In this slide, we are going to learn about factor affecting capital structure. First factor is sales stability. This factor is important factor while deciding your capital structure. Here one example is given. Two firms are there. One company is having stable sales, another company is having unstable sales. The company having stable sales can easily borrow fund from the market, and the company which are having unstable sales are not able to pay their business obligation easily. So the company having stable sales can easily borrow fund from the market. It is quite useful component in deciding capital structure for any business organization. Now we are moving forward to the another factor, operating structure. This topic is related with the operating leverage. Operating leverage, in the operating leverage, if your company's fixed cost is high, so company having high risk in the business organization. So if your company having low operating leverage can having less business risk, and it is useful for the any business organization if the business risk is less of any organization, so they can easily improve their value of the firm. So this is one of the important aspect of operating leverage for the decision in capital structure. Third point is asset structure. This factor is also important for the business organization because company are having two kinds of assets, general purpose assets and special purpose assets. But it is recommended that if company are using general purpose assets, it is useful for the business organization in good collateral situation. If company want finance from the bank or other financial institutions, so they can easily collateral these assets in the market and they can get fund for the future requirement of the business organization. Fourth point is profitability. This is one of the important factor for any business organization. If the profitability of the business organization is high, so they can utilize their own resources to manage their future goals and objectives and any other operations of the business organization. As mentioned here, the firm which get high rates of return on investment do not use high debt, but they can relatively use little debt. High rates of return on investment make them able to financing with the internal generated firms. So the company having higher profitability, they are using their own internal resources for the business organization operations. So these are the major four factors which are affect the capital structure. So we are going on our fifth factor, growth rate. This is also one of important factor to decide capital structure. If company is growing faster, if the growth rate of company is fast, so the company is relying on the external factor or external source of the fund. If company utilize external source of fund, so company may facing flotation cost. If the cost of capital of using external sources rises, so the overall cost of capital is also rises, and because of that value of the firm is going to decrease. This is very crucial factor to decide the capital structure. So the growth of the companies also affect the capital structure decisions of the business organization. Now we are moving forward to next factor, taxes. As far as tax concerned, it is important factor for any business organization. company are having using debt fund in the business organization, that debt fund is, and the interest on that debt fund is tax deductible. So the business organization are found that they are using more debt fund because of this tax deducted function. Clear is this is the reason that many firms are used debt, because firm tax rate is higher, then the firm is getting more advantage on that tax deduction portion. So this is also one of the important aspect for the any business organization. So tax is considerable as an important aspect in the capital structure decisions. Now we are moving forward to next factor, financial flexibility. Financial flexibility is one of the important aspect. If company is having good financial conditions, so they can easily go with the stock and bond options. So they not do not rely on the external finances like borrowing fund from the banks, or they can issue debentures. If the company's financial position is strong, so they can directly utilize their own internal resources, their own retained earnings, or either they can issue stock and bond. So this is also one of the important aspect which decides firm's capital structure decision. Now we are moving forward to the next point, that is firm's internal condition. If the firm's internal condition is good, likewise financial flexibility, so the company is not rely on more external funds, they can directly utilize their own earnings to expand their business organizations. They can use their internal source of finance to run their business activities. They are utilizing their resources to pay their obligations. Clear? So they are not going to borrow the money, and they are not going to issue stocks in the market to generate the or to raise the capital of the business organization. So the firm's internal condition is also important component in capital structure decision. If the firm's internal condition is good, so firm cannot rely on external resources. They can easily utilize their internal resource to develop their business organization. Now we are moving forward to our important topic of this chapter, capital structure theories. Here we have present some of the assumption of our theories. So our theories based on these assumptions. These are the important assumptions for the theories of capital structure. Assumption number one: firm use only two sources of finance, debt and equity. No change in the investment decision of the firm. No change in the total assets. 100% dividend payout ratio. No return earning is there. Business risk of the firm is not affected by financial mix. No corporate tax or personal taxation is counted. Investor accept future profitability of the firm. So these are the basic assumptions of the theory. In this slide, we are going to learn about net income approach. It is relevant approach of capital structure theory. This theory suggests that there is a relation between capital structure and value of the firm. And that is what the reason why this theory is known as relevance theory of capital structure. In this theory, there is a significant relation between capital structure and value of the firm. How we can say that? In the next point, the capital structure of the firm is influenced by the cost of capital and thus directly affect the value of the firm. So in this theory, we can suggest that if the cost of capital of the business is goes down, the value of the firm is increased. So in this theory, the direct relation of cost of capital and value of the firm we can see in this slide. NI approach assumptions. The assumption of NI approach is given here. NI approach assumes that the continuous increase in the debt not affect the perception of investor. Here the perception of investor is not changed if we are using more debt fund. If we are using more debt fund, our financial burden increase. But here the assumption is that the perception of investor is not changed. Cost of debt is always cheaper than the cost of equity. Clear? So the cost of debt is always less than the cost of equity. Corporate income tax do not exist. So here we are not consider any corporate taxes. So we seen in the last slide, cost of capital is reduced, our value of the firm is increased. As mentioned in the first point, in NI approach, higher use of debt capital will result in the reduction of cost of capital, because debt is a cheap source than the equity. So cost of debt is less than the cost of equity, and that is what the reason why the overall cost of capital of firm will be reduced, and because of that the value of the firm is going to be increased. Here the formula is given for finding out the value of the firm. Value of the firm is equal to earning before interest and tax divided by overall cost of capital. Clear? Earning before interest and tax is constant, WACC, overall cost of capital is reduced, and because of that value of the firm is going to be increased. Thus NI approach, a firm will have maximum value at a point where your cost of capital is reduced. At that point your value of the firm is maximum peak. As we discussed in the previous slide, if we are using more debt fund, our overall cost of capital is going to be reduced as mentioned in the graph. Cost of equity is constant. Company is using more debt fund, so overall cost of capital is reduced, and because of that value of the firm is going to be increased. And that is what the reason why it is the relevance theory of capital structure, where if company using more debt fund, the overall cost of capital going to be reduced, and because of that the company is having highest value of the firm because of this combination. So as per the proportion of debt in the capital structure increases, the overall cost of capital is decreases, and because of that value of the firm is going to be increased. Thank you.